You guys probably heard about or know about term deposits, you know about your residential or commercial property, and you kind of know a little bit about shares. We'll start with term deposits and then we'll break out a bit more from there. So we've got nominal returns and real returns. Nominal return is the headline return you get. So we've just taken this off real data. The current 1 year term deposit rate with the big banks is about 1%. Then take your tax rate off that. So there's your nominal return, and then take off the inflation, which before we said was forecast at 2.4, but right now it's at 1.5. So you take that off, and actually you're going backwards. So that's not really exciting, is it? We go, okay, well in that case we'll go a bit longer to get a higher rate. Well, here's the 5-year rates. Still a C of red. We've done two sets of numbers here. So we've done inflation at 1.5, but we've also in the bottom one we've taken off 2%, because if you're going to a 5-year term deposit rate, then you want to be thinking about what the long-term inflation rate is, which is probably more like 2%. So I guess term deposits probably aren't the long-term answer. We call it get poor slow. Property. So some will be in residential investment property, some will be in commercial, some will be in syndicates, range of that. This is just purely residential. These are recent numbers put together by ANZ, and this is off the back of the government's new tax implications. Yeah, so you know we've got that tax deductibility coming through, staged over the next 4 years. So what ANZ did is they worked out what does that do to the value of buying an investment property now versus before the rules came in. And actually it comes back to, it depends on how much you borrow. So LVR is loan to value ratio, the percentage of your debt to the property. Yeah, so at the moment you can go on the investment property, you can do a 60% mortgage as the maximum. So if you kind of go, okay, 60% LVR, and then it depends on the mortgage rate. You can get a 1 year rate at 2.25, you can get a 5 year rate at about 3.5 at the moment. So if we said 3 on a 60% LVR, basically you'd need to buy the property at a 4% discount today compared to what you would have had to pay for it a couple of months ago before the new tax changes came in.
To get the same return.
Get the same return, exactly. And those numbers get worse in 4 years' time because of the phasing of the tax. Now it's different to commercial, but just gives you an idea of property slightly less attractive now as a result of the changes. Yeah? Okay, so we talked about term deposits, we've talked about property, and you probably know a little bit about shares, but what else is out there? Well, there's 10 different asset classes. So let's talk about those. How am I doing on your line of sight? Good? Excellent. So we've got defensive, we've got alternatives, and we've got equities or shares. So this is where you start getting into some of them have got different names. Stocks, shares, equities, all the same thing. So if we're talking about any of that, it's all the same. Bonds, fixed interest, same thing. We'll talk about that. So the defensive side, we've got cash and we've got fixed interest or bonds. Cash, easy, money in the bank, term deposit, under the pillow, wherever it needs to be. Fixed interest. So fixed interest is kind of like term deposit, but it's where you lend to either a company or a government. And so the New Zealand government, if it wants to raise money, is that it can put up our taxes, or it can actually release a bond. And typically what they do is release a 5-year bond. You can actually get different terms, there's 10-year. Sometimes they're called treasury notes as well. So you might have a 5-year bond and they'll put an interest rate on it, or a coupon rate, which is similar to a term deposit. So the 1 year term deposit was 1%, the 5 years 1.6. Or you might have a 5-year New Zealand government bond of, 1.4%. And they'll pay you that quarterly throughout the 5 years, and at the end of the 5 years, they'll give you your investment back. And generally it's in $10,000 lots. So you lend them 10 grand, you get the coupon, and you get 10 grand back. Yep, no dramas. Fairly safe lending to the New Zealand government. You know, if you don't get it back in 5 years, we've got bigger problems. No problem lending it to the Australian government. No problem lending it to the US government. Anyone want to lend it to the Greeks? Or Zimbabwe? Or no? Okay, so we start getting into different risk profiles now. And this is where you get into credit rating. So each country has got a credit rating. And New Zealand is AA, I think at the moment. So you have AAA, AA, BBB. All of that is investment grade. So it's all, you know, and the lower the credit rating, the higher the interest rate. Because if you think about it, if I offered you 3 1.5% bonds, and one was with a AAA country, one was with a AA, and one was with a BBB, where are you putting your money? With a AAA. How does the BBB get your attention? Oh, we'll offer you 2%. How does a CCC get your attention? We'll offer you 10%, but you might not get your 10 grand back. Yeah? So what happens is below investment grade, you might have heard this term as it's called junk bonds. Now, there's a lot of return to be made there, but you may not get your money back at the end of it. Yep. So you can do it with government, you can also do it with companies. So companies can issue bonds. So they can, ways companies can raise money, they can go to the bank, they can issue bonds, or they can issue shares. Issuing shares is a really expensive way of raising money. Going to the bank can be expensive, it depends on the time and what requirements are in there, or going to the public can be cheap, depending. So you've got, you can buy bonds in Auckland Airport, in Fonterra, in Mercury, there's a whole bunch of ANZ Bank, a whole lot of them release them all the time. So you start going, okay, well, how are those companies doing? Well, they're all going to have credit ratings as well. Now, if Josh and I were to release a bond in our company, that may not be quite as attractive as, say, ANZ Bank. Yeah, so we would have a lower credit rating and have to put a higher interest rate. We're not, we'll just give you an example. And so that's what happened with the finance companies back in 2010, yeah, when they all went under with the global financial crisis, think about South Canterbury Finance, Hanover, those sort of companies. The issue then is that term deposit rates at the time were about 8.5%, and we had an official cash rate of 8.25. And the finance companies were doing bonds effectively, or fixed interest, at 9%. And you kind of went, oh, 8.5 from the bank, 9% from them, I'll take the extra half percent, probably pretty good. We never promoted them, but we looked into them, and the reason we didn't promote them is when we did the risk assessment on them, we felt that the interest rate should have been around 16%. Now, if you were looking at an 8.5% term deposit rate for 16% finance company, right, you're going to go, hang on, why is that double? What's going on there? But the fact that it was only 0.5% is where a lot of the issue was. So you've got to have, it's got to be priced correctly and it's got to be risk rated as well. Why is fixed interest deemed on the defensive side? Well, in a company, there's rules around who gets paid first when the shit hits the fan. And equity or shareholders are last. So that's why they're higher risk and also why you get a higher return, because you're taking on more risk, you're being rewarded for it. So you've got bonds, term deposits, corporate bonds, all of these are lower risk and get paid out first. So if a company's being wound up, and I'm not going to name one because I'll get in trouble, it's being recorded, but choose a company in New Zealand, really well known. If it happened to go bankrupt, and then the liquidators come in and they've got to basically divvy up whatever's left and pay it out, they've got rules as to how it gets paid out. And the bondholders are amongst the first. So that's why that's more secure and more defensive in terms of lending, but also it doesn't give you the return. All right, other asset classes. So I'm going to slip over to equity, shares, same thing. So we've got Aussie and New Zealand shares, so domestic. We look at Australasian because the New Zealand share market's so small, and as soon as our companies get big enough, like Xero, they go over onto the Aussie exchange. So we look at Australasia as domestic. You've got the global share market, so you've got US, Europe, UK, Asia, everywhere. And then you've got emerging markets, which is based on geography. So this is sort of think third world developing markets. So India, Indonesia, China, South America. So countries that are really growing and need a huge amount of capital coming in to help build roads and infrastructure and protein and all the rest of it, and mobile phone towers and all the rest of it. So you've got your shares, and then you've got alternative asset classes. So the top one here is commodities. So this is things like agriculture, mining, precious metals, all the different agriculture, all the different commodity types. You've got infrastructure. So you've got basic infrastructure are expensive projects that cost a fortune to build and then last a long time and bring in rent. So you think about an airport, to set up a brand new airport costs you an absolute fortune, but then you can just get the passenger traffic going through for the next 30 years. Same with building a toll road, building a data centre, building a pipeline, those sort of things. So that's your infrastructure projects. And then you've got property. So commercial property, industrial, office, retail, property developments, all those different kinds. So these are all the various different asset classes that you can invest into as part of your portfolio. Make sense? Cool. Okay on the pace and the language? Okay on time? Excellent. All right, so what do the different asset classes do? Well, we get different expected returns. So what we're doing here is we're looking out 10 years and trying to work out what the average annual return would be for each asset class, but it's over a 10-year period. Because the issue is that the longer you go, the more volatility we'll get to, the more it goes up and down. So our long-term forecasts or expected returns for cash fixed interest is around 1.1%. This is before fees, taxes and inflation. And global fixed interest, 1.9%. So that's your defensive, not really a lot of return there, and just a stabiliser in your portfolio. Then we've got our growth assets, so commodities, global infrastructure, Australasian property, global property, all around 7.6% per year. Aussie shares around 7, Australian shares, that is, global shares around 7.2, emerging markets 9.6, and then inflation at 2. So that's our long-term forecast over the next 10 years of each asset class per year. But that's the expectation. What's the last 20 years look like? Well, if we go 2001 to 2020, you're starting to see quite a bit of range away from the expected return. In fact, you've got commodities at minus 1.22% there compared to an expected 7.2. You've got emerging markets are about bang on. Some of them are pretty close, and your fixed interest and defensive have outperformed during that time. But then you go the decade before and it changes again. Commodities were up, global infrastructure did particularly well, global equities didn't do particularly well in the first decade. And that's because you had the tech wreck at the start, and then you had the global financial crisis. So you had a couple of big negative events hitting global shares during that time. And then you look at last year, and you go, oh, that's moved quite a long way away, yeah, from our expected return. And so we've got the defensive has done quite well, 5-6%. Then we've had commodities and global infrastructure and global property are all negative. So in any one year, you might actually move quite a bit away from the expected return. But over the decade, you tend to hit closer to the return. Is that making sense? So what we're going to do is put that into context and have a look at this. So what this is each year, each year right the way through 2001 to 2020, and at the top is the top performing asset class, and at the bottom is the bottom performing asset class. And the green ones are your defensive, and the other colours are your growth. And so we like this one because it shows us the really, really clear pattern of exactly which asset class you should be investing in, doesn't it? Everyone see the pattern? Yeah, they're in the same pattern. Yeah, I like to, my description of this, it feels like someone threw up on it. It just makes no sense at all. And to give you guys some ideas of some of the numbers, top performing asset for the year, 29.4%, bottom minus 20%. Top plus 26, bottom plus 2. There's a ripper here, here we go. Plus 15 at the top, minus 38. Yeah, that got nice, didn't it? So yeah, so we've got a few different bits in there. So this is where we want to get into diversification and go, well actually we want a bit of each of these different asset classes because we don't know which one's going to go gangbusters or not each year. So we've taken this in the same lines and the same colours and we've turned it into this, which is if you go back to 2000 and you put $10,000 into each of the asset classes, what do they do over that 20 years? So there's a bit of noise on that slide, so we go, well let's have a look at the defensive ones. So they're kind of quite smooth, aren't they? Not a lot of movement up and down. So you've got your cash, your fixed interest New Zealand, fixed interest global, with 3 green lines, and it's sort of carving quite a nice path through. But not giving you, it's giving you an okay return. But then you get into the growth ones, and we've got quite a bit of movement floating around there. So each of the growth assets is moving around quite a lot. Now we've deliberately gone back to a bad starting point because what most people do when they're trying to sell you something is that they choose a really opportune starting point and they make sure that this is going straight up really nicely. And we could have done that if we started here or even just in this bit here, but we actually started with a down bit just to show that actually that timing can make a bit of an impact as well. So okay, there's a bit of noise on where you go there. So then you go, all right, well what if we went into a combined portfolio of 60% growth and 40% defensive, which is often called a balanced fund. Yep. If you guys are in KiwiSaver or you've got kids in KiwiSaver and if they're in the balanced fund, that's generally what it'll be, about 60% growth, about 40% defensive, and it'll be a mix of assets. And you can see that black line there, that's the 60-40, actually has a bit of movement up and down, but it's a bit more stable than that one. Yeah? So that's what we're trying to do in the portfolio. So we're trying to go back to getting the right combination of those to achieve that. Make sense? Okay, so I'm talking a bit about volatility or movement around. So let's give a real working example. I'm going to give each of you guys 2 dice. And I want you each to roll them. Who thinks they're going to get a 2? Yeah, okay. Who thinks they're going to get a 7? 3, 4, okay. Well, let's have a look at it. Everyone remember the standard deviation curve from statistics? This is it. So what this is I got Josh to roll the dice 1,000 times. You've got a computer program to do it. So he rolled a dice 1,000 times, and this was the results. A 7 came out about 175 times. And the reason for that is that to get a 7, you need a 1 and a 6, a 2 and a 5, a 4 and a 3, a 3 and a 4. Yeah, so you've actually got a lot more chances. Whereas to get a 2, 2 1s. No other way you can get it. Or to get a 12, 2 6s. So your probability is suddenly thrown out by the number of options around it. And so the standard deviation curve basically tells you what's the probability of rolling each of the different numbers. We do the same thing with investment portfolios. Look kind of familiar? And so what we do is we're able to take all the different asset classes, and again, Josh rolled this 1,000 times with our forecast returns for each of the different asset classes in our portfolio to construct, and around 140 times, returns came out between 1.6 and 4.3% on average per year for 10 years. But around 5 in 1,000 times, it came out at minus 17 or plus 20. So that's 95% of the time, your portfolio will do between minus 17 and plus 20 in any given year, and around 4 or 5% on average. So that's what we're trying to do with the probability side of stuff. Does that make sense? Now, every now and then it falls out. So if I go to COVID last year, the news in the media was that the markets dropped about 35% with COVID. When the media is talking about the markets, it's usually the US stock market or global shares is what they'll be talking about. So the US market was down 35%, but actually fixed interest was up a little bit, and other asset classes were down different levels. A 60-40 portfolio was down about 17-18%, which is actually within the normal standard deviation curve. So actually it wasn't an anomaly. The COVID crash was actually within what we'd expect normal returns to be. Interestingly, the year finished up around plus 17-18%. And so in 1 year we had returns that were nearly at the bottom of the standard deviation probability curve and then at the top end as well. So really quite an unusual year, but still within the normal realms. Now when we had the GFC, global financial crisis, we were down outside that. So we were in the bottom 2.5%. It was an anomaly mathematically. Okay, glazing over, I'm going to move through. Okay, so how do you then access these different asset classes? Well, you've got, broadly, there's plenty of different ways, but broadly you've got direct, you've got managed funds, and you've got multi-asset. So direct is that you can go and buy the individual assets. So direct shares, I've just grabbed the number one stock by size on 4 of the largest exchanges. So New Zealand, Fisher & Paykel Healthcare is currently our largest. Australia, Rio Tinto, US is Apple, and UK is Unilever. So you can go and buy those stocks. Easy, go through a stockbroker, buy them, or go online if you want to, and you can hold those companies. You can also buy direct bonds on the New Zealand Debt Exchange or other exchanges. So you can go, that's a Auckland City Council. Yep, bond, 120, so you can go and buy that at the moment. Or you can buy direct property, direct alternatives. Some of you guys might have some commercial buildings or a syndicate or a forestry plot or stuff like that. So you've got different direct assets you can buy. That's all fine, but you've kind of got to manage it all and bring it together somehow. So you go, all right, well, what if I don't really want to have the skills or time or be bothered doing that, I want someone else to do it, how do I get the right mix? Well, you can go into a managed fund. And so what a managed fund, or what a fund manager does, is that they'll specialise in a certain area and then they'll buy up all the different directs and put them together into a portfolio. And so these are some of the managers that are around. So for example, some of these specialise, so Mintz is specialising in Australasian shares, one of their models, or Australasian property is another one. Magellan have got global shares and global infrastructure. The Harbour have got New Zealand shares, New Zealand fixed interest, some global shares. T. Rowe Price is global shares. PIMCO is global fixed interest. PIMCO are managing 1.6 trillion US. 1.6 trillion US. Put that in context, the New Zealand KiwiSaver market is 80 billion. So, WCM global shares, and then Vanguard and Beta shares are index funds, so basically with managed funds you've got active and passive or index. Active it's a company with a group of people that are actively making decisions to buy and sell shares. So when the COVID crisis hit last year, these guys were all out of airlines, hotels, cruise lines, anything tourism related. Yep, the active managed funds got out of that, and guess what they got into? Zoom, Amazon, Visa, because we're all buying stuff online. Yeah, so they went straight into where the consumer was going to be going to. Whereas your passive or index funds are tracking the index. So you can buy the NZX10, which is buying the 10 shares on the New Zealand Stock Exchange, or the NZX50, or the Aussie 300. Now in that, you're going to have Air New Zealand, and Qantas, and some hotels. And yeah, so with an index fund, they're really cheap and you hold the market, but at times of crisis, you can't get out of certain sectors. So they've both got pros and cons. Index, really cheap to run and just give you the market. And then active, more expensive, but you've got experts, theoretically, that are picking and choosing the right area. And then you can actually select them by sector as well. So to give you an idea, this is two funds that we use. I've done an Australasian share fund and a global share fund. Just have a look through and see how many names you recognise. Those at the back that may not be able to read it. On the Aussie, Australasian, we've got Fisher & Paykel, Healthcare, Infratil, Spark, E-Road, Somerset, Contact Energy, Sky City. So a few names to know. Z Energy, HA Milk. Yeah, so companies you kind of know, by and large. Global shares, Microsoft, Alphabet, which is Google, Facebook, Starbucks, Alibaba out of China. Anyone bought anything on AliExpress? Yeah, no, some. Tencent, also out of China. Visa, Netflix, so Pepsi, SAP. You know, these are companies you kind of know. Yeah, so I think the problem with managed funds is that it's sort of this mysterious kind of, you know, everything's pulled and who knows what they're doing. They're doing that. Yeah, and they're just selecting. And that will look different next month. Maybe not hugely different, but it looks a lot different from a year ago to that much. Yeah? And then you kind of go, okay, well, how do I select each of the different managed funds and how do I know who's good and who's not? And how do I get the right mix? Well, if you wanted to, you could go into a multi-asset. So you could go into your conservative or your balanced or your growth. And all that is mixing up these guys who are investing in this stuff. Does that make sense? It'd be great if they taught this in school, wouldn't it? So much easier. But yeah, so if any of you are in KiwiSaver, that's what you're doing. Yeah, if you're in the balanced fund, if you go and pull out your product disclosure statement for your KiwiSaver, it'll tell you, if you look up, say you're in the balanced fund, it'll tell you which of these ones you're invested in. And some of those names will be in there. There'll be some other ones as well, depending on who the manager is. Some of them get a bit tricky because they actually put their own name over the top of it. And so they'll have like the ASB Global Equities Fund. It's actually their guys. Yeah? So you can look through, you then need to go and look for the SIPO, which is the Statement of Investment Policy Objectives. Cool, so it makes sense there? Alright, so how do you then access that? Well, if you want to go down the direct route, then you can go direct. You can go to a stockbroker, or you can go online. Sharesies, Hatch, heard of any of those? Sharesies is making the media a little bit. Yeah. So you can buy some shares out of the US, which is Hatch, or you buy them out of New Zealand. And so you can get your directs that way. With the fund managers, you can go through a bank, you can go through a platform, you can go directly to the manager. So if you wanted to go into the Mint Property Fund, you can contact them and you can fill out a 20-page form and you can invest into it. That's okay with one of them, but if you're building a diversified portfolio with 15 managed funds, do you really want to fill out 15 forms? And particularly, what if you then want to add another $1,000 in? Do you want to fill out another 15 forms? And then what if you want to take $5,000 out? So maybe not that practical, but you can do it. Or you can get on something called a wrap platform. And wrap is really technical language for our industry. It's one of those jargon things. It's just wrapping your investments up into one place. That's all it is. And it's putting them on a piece of software. So it's not an investment product. It's a place that you can view your investments. It's a bit like Google isn't the internet. It takes you to the web page you want to go to. This takes you to the investments you want to go to. There's broadly 2 or 3 platforms, wrap platforms in New Zealand, but then there's about 20 brands that sit on top of it. I don't know if you know the term white labelling. It's when you put your logo over the top of someone else's product. Quite common, yeah? So a lot of people will white label on top of one of those. Okay, so why use a wrap platform? Well, it kind of does everything. So you can invest in direct bonds and direct shares if you want to. You can buy them straight from the New Zealand Stock Exchange or any stock exchange you want. Or you can buy managed funds, and you can buy your defensive and you can buy your growth, and you can get access to thousands of them. In fact, FNZ platform's got 11,000 managed funds in them. And you can see them all in the one place. And so you can then see them nice and diversified through your asset classes. So you can see what you've got in your cash and your fixed interest and your alternatives and your equities, your property. And then what our friends from Dipros love is a nice consolidated tax report. It takes care of everything, and a tax guide.
What doesn't quite take care of everything?
That's right. Makes their life a little bit easier. And then for you guys, there's consolidated reporting, but also 24/7 access. Because I think one of the things is being able to see what you've got. And so being able to log in and see in real time exactly what you've got, quite nice. And the beauty is that you can see, but you can't break. You actually don't have trading access. So you can log in, you can run reports, you can play with stuff, you can click on buttons, and you don't accidentally buy a whole lot of Tesla or sell everything. Quite useful. And also access as well. So if you wanted to buy something out of the US or the UK or Europe or Australia or New Zealand, you can. You've got access to the whole lot. They're quite nice. Okay, so you go, all right, I want to build an investment portfolio, I want to do it on a wrap platform, where do I start? Well, you need to start by understanding how much risk do you want to take on and do you need to take on. And so there's three parts that make up your risk profile. There's your behavioural risk tolerance, which is your psychological profile around risk. So we get you to do a questionnaire, and for most of you it'll say, oh, I'm really conservative, including those of you that own 7 investment properties, a racehorse, and have done futures with farming stuff. So most people go, oh, I'm really conservative, I don't like to take risks. But we'll get into views on risk shortly. Risk-taking capacity is time, which is, we saw the volatility before, and so time cures everything. Now, if you wanted to invest for 3 years, you need to be in cash, because you can't afford a COVID-like crash to drop 30% out of your portfolio when you need the money. But if you're investing for 10 plus years, then you can take on a huge amount of risk because the market will run itself over time. And then somewhere in the middle is that you blend it. And then we've got risk return need, which is, I've got this much money and I need this much to live on. Do the two compute? So, if you've got $10 million and you want $1,000 a month, you don't need to take on any risk. You can leave it under the mattress. But if you've got $1 million and you want $10,000 a month, you need a pretty high return on that, depending on how long you need it for. Yeah? So we get a blend of those to build your right risk profile, and that's how you get into things like a balanced portfolio of 60-40 or a 70-30 or an 80-20, these kind of splits. But what does risk mean? So how many of you identify with any of these? Risk of total loss, is that something that comes to mind? You worry about losing all your money? Is that something that comes, yeah, that's fairly common, so I'm going to come back to that in a second. What about the risk of not achieving your goal? What about not actually having enough money to do the things that you plan to do? Is that kind of risk? Or the risk of running out of money. If I go and spend that money now, can I afford to pay the food or the heating bill in 10 years' time? What about the risk of inflation, reducing your purchasing power? Yeah? And then volatility, so how much do you freak out when the market drops or the market goes up? I'm not going to name them because you know them. But someone called me, and when the COVID crisis hit, he'd been in for a long time, and he said, look, I know I only ever call you when the market crashes. And I'm like, yeah, I noticed you don't call me when it suddenly jumped up 20%. He had a good laugh, thought it was a fair call. He hasn't called me since. But as humans, we're risk averse in terms of loss far more than in terms of gain. Risk of total loss. Let's just go back to these. So if you're in this fund, for total loss to occur, every one of those companies would have to go bankrupt. I think we've got bigger problems if we've got the end of Microsoft, Google, Facebook, Starbucks, Visa, Netflix, Pepsi, Zap, something, a meteor's hit the US at that point, I think, and wiped it out. So risk of total loss is actually not realistic. In the same way that, if you go, if your property prices drop down, well, you can wait it out for it to come back up again. The risk is only if you need to exit out of it at that point in time. Okay, so then we go, well, also where are you in the cycle is quite important with how much risk you take on. So this is our language: accumulator, transition, and decumulator. So your accumulators are generally trying to acquire as much wealth as possible for later in life. You're putting away now to spend in retirement. Yep. So really what you're after there is maximum growth. Give me the most return that I can get, that I can tolerate. Yeah. Then you've got your transitioner, which is kind of a strange time, and there's no hard, I'll put roughly around ages here, but it's about a 5-year period we've experienced where you kind of stop contributing, you start consolidating your different investments together, but you're not quite withdrawing yet. It's sort of that transition into retirement, and you sort of like, you're not saving, but you're not spending, and so you're kind of easing it. And so some of the things that are starting to come together, and you're sort of wanting to bring some of these things kind of into the one place so that you know kind of how much you got to live on for retirement. Does that make sense? And now some of these are direct, some of them will have some large amounts, some of them are more, so we talk about liquidity, which is how easily you can convert something to cash. Yeah, so money in the bank, very liquid. Money in a term deposit, slightly illiquid depending on how long it's there for. 90 days, that's reasonably liquid. 5 years, not so much. Residential property, at the moment, probably 3 to 4 months when you think about listing through to settlement. Commercial property, probably a bit longer. Farms, a bit longer again. Yeah, so you've got different parts of it. Forestry, 23 years, 24, 25 years. Yeah. So you're starting to consolidate this stuff together to prepare for decumulation, which is you can no longer generate any revenue from going to work. So the portfolio has got to generate it for you and has got to pay for your retirement. Now, part of the problem with that is we don't know the magical end number. Yeah? And as you get older, that number pushes out. So when we're born in New Zealand, males' estimated average age, life expectancy is 81, 82, females 82, 83. But by the time you get to 65, that's actually pushing out to about 87, 88. And we've got a client who's 91, her life expectancy is now 95, 96. So the older you get, the more the statistics actually will push out for you. So it's around going, okay, well, how do I withdraw and how do I make this last? And also, where do I get the money from? So one of the great things about an investment portfolio is that you can take out 3, 4, 5, 10 grand a month, every month, and still stay in your asset allocation. You can't sell your lounge room to pay for the groceries. So these direct assets actually, they're great early on, but they become a problem in your decumulation stage because you can't actually sell part of the property to fund your retirement. Now, some of you might go, well, I can live off the rent. Maybe, but we're finding that clients are spending around 4% of their portfolio every year, and we're finding property yields are around 3.5 gross. So take off fees and taxes off that, you're kind of down to the 1. It's not actually producing enough. Now, some of you will be in commercial, 4 to 6%, great, but still take off tax and fees and vacancy and everything. You're probably still a little bit low. It might work during transition, but getting into decumulation, there's a point where it becomes a problem. The other thing in retirement is that actually you don't spend the same amount all the way through. I'm yet to find a 95-year-old that wants to get on a plane to London, COVID or no COVID. Not interested, yeah? They did some studies out of Australia, and because they've had superannuation a lot longer, we've had KiwiSaver, and a lot of the retirees were spending 50% of their retirement capital in the first 5 years. Yeah, because you stop work and you've got time on your hands. When you've got time on your hands, you spend money. And you fit healthy, you want to go places and do stuff. So in this model here, we actually just reduced down, so this was just a hypothetical portfolio, and we just said actually from about 65, 66 through to 75, spending 125 grand a year after fees and taxes, plus NZ super. So that's probably about 150 grand a year. Then drop it down to 100 grand a year plus super, then down to 75, then down to 50, and then we ran this down at 40 and 30 in the last couple of years. Because your expenses, 95 to 100, probably not going to be that high. Yeah? Give the grandkids $5 to go to the shop. So the decumulator there, we've run the capital down, but you don't have to. So there's capital preservation and there's capital depletion. So capital preservation is that you actually have your investment capital that stays the same all the way through and you just live off the returns. That's one way of doing it. And then capital depletion is that you eat the capital. Now, if you guys have been in term deposits, this will be a fairly uncomfortable kind of idea, because the fear of, we go back to the risk, the fear of running out of money probably starts to come into play. And sometimes there's also, what about the kids with the inheritance? I'm not going to say screw the kids' inheritance, but they're going to get the house that you're living in. So they're going to do fine. Yeah, don't worry about that. This is yours, you've earned this. And you don't have to run it out completely. In reality, it'll come down to a number somewhere here, and you get to determine what that is. We can do modelling around it to help you. But effectively, we always model to 100, because if the average age from retirement is that you live to is about 85, well, half of you are going to live beyond that. So we don't want the money to run out at 85. And why we like modelling out to 100 is because actually, if this isn't generating enough revenue, you need to take out more, or you can either spend less, or you can bring this date in a little bit. So you've got options. And the other thing is that you can track it. And you can start, I wasn't saying take your, sorry, I wasn't saying bring the date in by, no, as in when the money starts to run out. But I know a guy. So you can actually spend less. But the other thing is that you track along this line here, and actually if the returns were better than forecast, because we like to forecast pretty conservative, well then actually you can start spending the surplus. And in fact, we've got one client who's supposed to be about here at the moment, and she's here. So we're brainstorming every 3 months ways to spend more money. We've now got organic food being delivered to her from all around New Zealand. We've got a chef coming in once a week to cook her and her husband dinner. We're coming up with whatever we can to get her to try and spend much. She's got the cleaner coming 3 times a week now. So this, she needs to be back onto this trajectory. So so look, this can be a little bit uncomfortable in terms of eating the capital, but actually it will give you a lot more to spend through retirement, and it can be done safely so that you don't run out, and you can adjust along the way. Yeah? Cool. So then so we're trying to build out your portfolio, and we go, all right, well, what's the portfolio want to do? Well, we want to have a core portfolio which is covering all that stuff that we said, all your cost of living, all your usual expenses, your trips, all the rest of it. Then we go, all right, well, do you have any other things that you want to do? Do you want to leave a legacy, like something to the kids or the grandkids, or do you want to have a charity or some other kind of philanthropy, or some of these acronyms? Do we all know what the acronyms stand for? No? Okay. BHAG is